Energy prices, central bank decisions, and AI earnings are all converging at once, and together they could decide whether this equity rally keeps grinding higher or finally blinks. You are watching vTalkInsight, Equity Pulse Daily for April 28, 2026. Let us unpack how a packed policy calendar, a deepening energy shock, and make-or-break results from megacap tech are setting the stage for the next move in global equities. Global equities are heading into a dense stretch of events where monetary policy and an energy shock are colliding. The Federal Reserve, Bank of Japan, European Central Bank, Bank of England, and Bank of Canada all meet over the coming days, and the base case is that policy rates stay on hold. The nuance will be in the tone, because central banks remain highly alert to inflation but prefer to wait for clearer signals from growth and energy before making big moves. Rate expectations have shifted decisively toward a higher-for-longer profile. Several voices now see the risk of a Fed hike as greater than that of an early cut, and consensus has moved to zero or at most one rate cut by year-end, reflecting persistent inflation concerns. Front-end yields have jumped since the Iran conflict began, while benchmark Treasury yields have edged higher again, reinforcing the idea that the neutral policy rate may be above where markets assumed last year. Leadership risk at the Fed is another layer in this story. Kevin Warsh's nomination is progressing, and a change at the top could mean less reliance on detailed forward guidance and, at least initially, less predictable communication. Against a backdrop of potential shifts toward growth-focused fiscal measures that could raise deficits and inflation, markets may have to live with more policy uncertainty even if rates themselves stay unchanged. Energy is the other major macro swing factor. The ongoing closure of the Strait of Hormuz is sidelining a large share of Persian Gulf production, pushing Brent above $107 and lifting both short and long-dated contracts. Global inventories are trending toward record lows. Producers are hedging prices above $90, and Goldman Sachs has raised its fourth-quarter Brent forecast to 90, arguing that supply buffers are now extremely thin. This combination is feeding a stagflationary narrative, especially for Europe and Asia. Commentary warns that if disruptions persist for another month, a European recession looks hard to avoid, while Asia is already seeing rationing and business closures as energy shortages bite, and the shock is hitting not only oil and gas, but also key materials such as helium and aluminium. Yet U.S. growth is still running near 2% with a stable labor market. AI data center investment is cushioning the blow, and risk assets have at times rallied alongside oil, which suggests that many investors still see the shock as manageable even though market structure looks fragile. While macro risks build, equity leadership remains dominated by AI and megacap technology, and this earnings week is a key inflection point. Alphabet, Microsoft, Meta, Amazon, and Apple together account for a very large share of S&P 500 market value, and optimism in equities is heavily tied to these firms delivering another round of strong results. Investor attention is firmly on whether robust earnings can still justify elevated valuations and sustain their perceived safe haven status. The backdrop is an extraordinary AI investment boom. AI-driven capital expenditure by major tech firms is projected to reach roughly $650 billion this year, with Microsoft, Meta, Amazon, Alphabet, and Nvidia lifting capital spending close to 60% year-on-year. AI infrastructure providers such as Anthropic and OpenAI have more than doubled their annualized revenue run rate to around $70 billion, showing that monetization is already meaningful rather than hypothetical. That wave of spending is acting as a powerful private sector stimulus, but it also strains balance sheets. Amazon is expected to report about $13 billion of negative free cash flow for the first quarter, and there are growing concerns about how long companies like Meta can sustain elevated AI infrastructure budgets without further pressure on cash generation. As a result, any signal that big tech is shifting toward more disciplined or slower capex growth could be interpreted as a healthy move rather than an immediate bearish turn for AI. Expectations are tight, and history shows how unforgiving the market can be when growth undershoots the whisper numbers. Microsoft's Azure is forecast to grow around 38% year-on-year, but prior quarters have seen strong cloud results still trigger sharp stock pullbacks when they fell a little short, with retail and algorithmic flows amplifying the volatility. At the same time, Microsoft and OpenAI have revised their partnership, ending Microsoft's exclusive distribution rights and revenue sharing, which opens the door for competitors such as Amazon to deepen their own AI cloud offerings. Legal and regulatory currents add further complexity to the AI narrative. The Musk versus OpenAI trial could delay OpenAI's listing plans and reshape governance across the industry, with knock-on effects for major backers like Microsoft and Nvidia and potential opportunities for rivals, such as Anthropic. In China, regulators have blocked Meta's planned $2 billion AI acquisition, and DeepSeek's aggressive 75% price discount on its model has raised the risk of a renewed price war, both of which could pressure margins and chill cross-border deal-making in the Chinese AI sector. Nowhere is the tension between growth and valuation more visible than in semiconductors. The Philadelphia Semiconductor Index has surged about 40% this month, extending an 18-day winning streak and pushing far above its long-term moving average, levels not seen since the early 2000s. That parabolic move, combined with peak valuations, has several analysts warning that a near-term correction is likely, even if the longer-term AI demand story remains intact. On the fundamental side, AI demand continues to look powerful. Agentic AI workloads require significantly more computational resources than previous chat-based models, and high-bandwidth memory remains a critical bottleneck for AI infrastructure with strong pricing power expected for at least the next 18 months. High-bandwidth memory suppliers are reporting robust earnings growth that is outpacing share price gains, and commentary suggests that until hyperscaler capex slows meaningfully, these names could continue to enjoy favorable dynamics. Cyclical Asian semiconductor leaders are also drawing capital. Samsung, SK Hynix, and TSMC are benefiting from strong memory demand and earnings momentum, with Samsung expected to post a dramatic increase in operating income, potentially around 600%, even though forecasts remain wide. Analysts have turned more constructive on memory specialists such as Micron and SanDisk as well, highlighting memory's growing importance in AI applications and setting expectations for sustained demand. Individual names show how AI enthusiasm is feeding into price action. Qualcomm shares jumped more than 10% on reports of a potential collaboration with OpenAI and Johnny Ive on an AI-focused smartphone, while Melius and others have highlighted memory as a key beneficiary of AI infrastructure build-out. At the same time, Northland Securities has downgraded AMD on concerns about intensifying competition from Intel and from Nvidia's collaboration with TSMC, underscoring that within the broader AI trade there will be both winners and relative losers as the cycle matures. Stepping back, the broader equity picture still shows narrow leadership. Recent gains have been highly concentrated in chip stocks and a handful of technology names, with little sign of a broad-based advance across sectors, even though global equities have shrugged off rising oil prices and geopolitical tension. Fund flow data point to improving sentiment toward financials, weakening appetite for energy and industrials, and growth-oriented mandates that are less under pressure than they were earlier in the year. Company-level signals outside tech paint a more mixed backdrop. Domino's Pizza has disappointed on comparable sales and cut its outlook, sending shares sharply lower and highlighting competitive and macro headwinds for consumers, while Verizon surprised with a gain in phone subscribers and a pre-market rally, suggesting some early payoff from new leadership. In Europe, Sainsbury's has been hit by double downgrades on margin concerns. Ryanair is under pressure from rising fuel costs, but gold miners are enjoying strong profitability, with gold prices comfortably above production costs. Credit and primary markets add another dimension to the equity outlook. Private credit portfolios with heavy software exposure are facing mounting AI disruption risk, and retail-oriented vehicles are seeing redemption pressures, while institutional allocators have largely stayed put and may be able to acquire assets at more attractive valuations. At the same time, a structural reduction in public equity supply is setting the stage for a powerful IPO wave, with potential listings from SpaceX, OpenAI, Anthropic and others expected to inject significant new market value, even as more cautious deals like Pershing Square's planned $5 billion fund show that investors are becoming more selective. Putting it all together, equities are sitting at the intersection of three big forces: a higher for longer rates backdrop, an energy shock that is flirting with stagflation abroad, and an AI and megacap tech complex that still carries most of the market's earnings hopes. This week's central bank meetings, oil headlines and results from Microsoft, Alphabet, Meta, Amazon, Apple, and the leading chipmakers will go a long way toward deciding whether the current narrow leadership can persist or whether we see a broader repricing in cyclicals, energy-exposed names, and high-valuation growth stocks. Key signals to watch include how hawkish central banks sound with policy on hold, whether big tech leans into or reins in AI capex, how semiconductors trade after a near parabolic run, and whether stress in consumer, airline, and private credit pockets starts to widen out or remains contained. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.